Well, there's going to be a bad ending. I wouldn't call it a policy mistake. The mistakes have already been made, and now we're at a point where we're like, okay, how do we get out of this? And I hate to use cliches, but between a rock and a hard place is probably as good as any. So the rock is a recession at best, maybe something worse, something more like a global liquidity crisis. The hard place is inflation, worse than what we're seeing already. Those are the Fed's two choices. This notion of a so-called soft landing, where we can raise interest rates a little at a time and get inflation under control, but keep the economy going. That's not going to happen. We're either going to have a recession, or the Fed will at some point balk. Not like what's going on in the markets, throw in the towel, in which case inflation will take off. Now, it's clear that Powell said we're going to get rid of inflation. We're going to subdue inflation. We're not going to stop until that happens. By the way, if you look at what Powell actually said, you got to be a little bit of a geek and watch the whole press conference and take notes and get a transcript and all that. Not the FOMC statement. That's a little bit. I know the guy who writes those. It's a little cut and dried. But what Powell actually said, it was interesting. At one point, he said the U.S. economy is in great shape. Worse to that effect. But that was pretty much exactly what he said, which is nonsense. It's not in great shape. People ask me, are we going to have a recession? And my answer is we might be in a recession right now and not even know it. U.S. growth, talk about the U.S., but Canada, EU, Japan, and others are not much better. We could be facing a global recession, including China, but just focusing on the U.S. Because that's the Fed's sort of territory. First quarter growth was negative 1.5%. So we have that. We have the Atlanta Fed GDP estimate of second quarter growth. Second quarter's not over. We've got a few more weeks, and we won't know the actual number until late July. But they have a pretty good track record. It's not perfect, but it's probably the best tool out there. And they're showing second quarter at 0. Well, where I went to school, negative 1.5 plus 0 equals negative 1.5. In other words, you're going to have a decline in growth for the first half. Based on where we are now. Now, things are getting worse, so that 0 could tip into negative, in which case you could have 2 consecutive quarters of declining GDP, and that is the definition of a recession. So my point being, we might be in a recession already. We'll find out later this year, but the data right now certainly points in that direction. So Powell saying the economy is great is nonsense. What he said, if you look at all of his other forecasts, he said, by the end of the year, we could be looking at 4.2% unemployment, 3.5 to 4% interest rates, and, kind of 2.7% inflation. Like, wait a second, inflation is 8.6 today. How do you get to, 2.7, number one? And then what about rising unemployment and higher interest rates? How do you reconcile those things? He said all three of those things. But what state of the world could make those things come true? There's only one, which is a recession. A recession would do it. A recession will raise unemployment. Higher interest rates will cause the recession. And the recession will cause inflation to go down. So in effect, Powell was saying we're going to have a recession. And this is why Wall Street reacted the way it did. Wednesday afternoon, it rallied. But that's just algorithms and short covering and some technical factors. Thursday, it sank like a stone. But that was people getting a good night's sleep, waking up and say, wait a second, he just told us we're going to have a recession. And my point is, not only is he right, we may be in one already. Right? I think that's, you pointed to exactly the issue. Now, inflation, prices go up, so we understand that, or maybe put differently, the value of your money goes down. You don't get as much for your money, same thing. But inflation, broadly speaking, has two causes. One is called, not to get too technical, but it's called cost push. This comes from the supply side. So there's a shortage of oil. And we got a financial and economic war going on between Russia and the United States. U.S. really started, but U.S., EU, Canada, Australia, Japan versus Russia. That's obviously disrupting supply chain, cutting down energy supply, causing the price of oil to go up, et cetera. So that's coming from the supply side. And you're exactly right. The Fed can't drill for oil. The Fed can't plant wheat. The Fed can't make semiconductors, so they can't do anything about this. And the supply chains are breaking down. They were breaking down before the war in Ukraine, but Ukraine has made it worse. The other source of inflation is called demand pull. And this is when individuals, you, me, and all of our viewers and everyday Canadians and Americans worry about inflation. We say, well, I'm just thinking about buying a refrigerator. Better buy it now before the price goes up with a car, house, or whatever it might be. They're different, but they affect each other. When the cost push inflation from the supply side has enough effect, there's a tipping point or critical threshold in psychology. We say, maybe it is out of control. I better go buy some stuff. Then the velocity of money goes up, and then you get inflation. So the Fed can't do anything about cost push. They can't do anything about the price of oil, and you're right about that. But they're looking at the demand side, saying, hey, if this supply thing goes on long enough, eventually the psychology will change and we'll get demand pull and behavioral, and that is really hard to change. So what they're trying to do, they know they can't change the supply side, but they're trying to squash the demand side before it gets out of control. Now, the question, of course, is can they do it? The answer is they can do it, but at what cost? So a general rule of thumb, this is really simple. You have to forget about nominal interest rates. Nominal interest rates are the rates you see on your screen, you hear about in the headlines and all that. Real interest rates are nominal interest rates minus inflation. Take the inflation out and see what's left. Well, right now, real interest rates are about 2%, actually 1.75% under the Fed's policy rate. Inflation's 8.6%. So, just round numbers, 1.5 minus 8.5, that makes the inflation rate -7. It's nowhere near. It's got to be +2. Real rates have to be +2 to squash inflation. Right now they're -7. So that implies that the Fed has to raise interest rates to 10.5% to get to +2 real interest rates. That's never going to happen. They're never going to get there. They will destroy the economy long before they get there. So the Fed has no hope of squashing inflation from the demand side, as you described, by raising rates, unless inflation comes down for other reasons. So what they're going to do, they're going to keep raising rates, 2, 2.5, 3, 3.5, 4, hope that inflation comes down from 8 to maybe 3, although I think that's a stretch. You could get into positive real rate territory, but they're really far away from it. So I think, by the way, I described what they're trying to do. I should make it clear they're going to fail. The only way inflation comes down, the way we're talking about, is if they trash the economy, a severe recession. If that happens, you say, well, do people still need to put gas in their cars? Well, you're right, but not if they're unemployed, because they're not going to work.